Hmm. Okay. Here's something strange. Ask 10 Singaporean investors what they own, and almost all of them will mention a REIT before they mention a stock. Not Apple, not Nvidia, not even DBS most of the time. They'll say Mapletree or Capital Land or Fraser Centerpoint. Why? Why does one small country have one of the strongest REIT cultures on the planet? Let's start with something you probably already do. Every month, money comes in, salary. Then money goes out, rent or your HGB loan, groceries, maybe a bit for parents. And whatever's left, if anything, you try to save. That rhythm, money in, money out, every single month, that's the rhythm of your whole life. And REITs speak that exact language. A REIT pays you quarterly, sometimes monthly. It feels like rent, except you're not the one collecting the keys or fixing the aircon. You just own a slice of the mall, the office tower, the logistics warehouse, and the check still comes. That's the first reason. REITs don't feel like investing. They feel like income. And income is something every Singaporean understands in their bones. Here's the second reason, and it's just as powerful. Think about what a REIT actually owns. Ion Orchard, Changi Business Park, a data center in Tompines you've probably driven past without even noticing. These aren't abstract businesses running on ideas you can't picture. You've walked through the mall. You've queued for bubble tea in the atrium. You know exactly what you're buying. Now compare that to owning a stock, say a semiconductor company. What does it actually do? Something about chips, something about supply chains, right? Most people can't explain it in one sentence, but a REIT, I own part of Junction 8. Done. Understood. No further questions. So you've got two things working together, predictable income and a business you can literally see and touch. That combination is rare, and it's exactly why REITs became almost a national pastime here. But, and this is where things get interesting, there's a quiet assumption sitting underneath all of this, an assumption that's costing people money without them even realizing it. Most REIT investors, if you ask them honestly, think of REITs as something close to a bond, a safe income machine. Set it up, collect the check, repeat, forever. But that's not actually true. A REIT is not a bond. A REIT is an equity. It trades on the stock exchange. Its price moves up and down every single day, sometimes violently. And that single misunderstanding is probably the most expensive mistake in Singapore's investing culture. Let's break down why. First, interest rates. REITs borrow heavily to buy their buildings. When interest rates rise, two things happen at once. Borrowing gets more expensive, which eats into the income they can pay out, and at the same time, investors start comparing REIT yields to safer options, like fixed deposits or T-bills. If a T-bill pays close to what a REIT pays, but with far less risk, money quietly starts flowing out of REITs. Prices fall, not because the mall got worse, just because the comparison changed. Second, debt refinancing. Here's something most retail investors never think about. REITs don't pay off their loans in one shot. They roll them over again and again every few years. So when a REIT's loan comes due during a period of high interest rates, it has to refinance at a much higher cost than before. That new, heavier interest bill comes straight out of the income that would have gone to you. Your quarterly payout can shrink even if the mall is just as full of shoppers as ever. Third, the buildings themselves. A shopping mall depends on foot traffic. An office tower depends on companies actually wanting office space. A logistics park depends on trade volume staying strong. When any of these slow down, say more people working from home or a slowdown in regional trade, occupancy drops, rents get renegotiated lower, and the income stream that felt so reliable starts to wobble. So here's the uncomfortable truth. The thing that made REITs feel safe, a real building, a real mall, a real business you can see, doesn't actually protect you from these risks. It just makes the risk easier to ignore.
Now, this doesn't mean REITs are bad. Not at all. It means they've been mentally filed under the wrong category. People plan their retirement income around REITs the way they'd plan around a fixed deposit. And when a downturn hits, like it did during the pandemic, when mall REITs saw their payouts cut hard, that mismatch between expectation and reality is where real damage happens. Not because the investment failed, but because it was never a bond in the first place. So what does this actually mean for you? It means REITs deserve a place in a portfolio. The income, the tangibility, the local familiarity, those are genuine strengths. But they belong next to other things. Broader stock market exposure, maybe global diversification, so your entire financial future isn't tied to Singapore's malls and offices alone. Because right now, many Singaporeans have built a financial future almost entirely out of one asset class, simply because it felt the most familiar. And familiarity isn't the same thing as safety. Here's a simple way to think about it going forward. If a REIT's price can fall 20% in a bad month, and it can, then it should be treated with the same respect you'd give any other stock. Understand what you own, understand what moves it, and build around it instead of building entirely on top of it. Because the goal was never just income. The goal was always financial security that can survive a bad year, a rate hike, or a quiet office tower nobody's renting anymore. Singaporeans didn't fall in love with REITs by accident. It made sense. It still does. But loving something and understanding it clearly, those are two different things. And the investors who do both usually end up the ones still standing, check in hand, 10 years from now.